Let's talk about SoFi. SoFi, the stock itself, has done horribly since the start of the year, down close to 30%. Now, if you're not following the business, you might think, okay, it's because the business is doing horribly, and so the stock has to follow that. Well, if you are following the business, then you're on the opposite side. You're saying the stock doesn't understand, the stock market doesn't understand that the business is becoming better and better, that this is a company that is growing quite fast and becoming more profitable along the way as well. Because currently, as you can clearly see right here, stock is trading at around $7, market cap under $7 billion. Yes, a forward PE right now 67.1 times. But if you look at the analyst estimates for the coming fiscal year, this is growing quite fast. You're basically paying 13 times or so fiscal year 2026 EPS. Now, looking at the average price target, we can see that first of all, there are 18 analysts covering this company, 10 with a hold rating, 3 buy, 3 sell, 1 strong buy, 1 strong sell. But other than that, we have here an average price target of $9.34, representing close to 33% upside from the price we're at today. So what's going on here? Is it purely sentiment based? Is it short sellers? Is it something else? Well, we're going to discuss this in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. First up, I want to remind all of you that this is the looks of a company that is doing extremely well, up and on the right, with regards to members, with regards to products, with regards to Galileo accounts, although we had a short period where this was slowing down. More on the technology side of the business in a second. Quarterly net revenue goes up, quarterly adjusted EBITDA has exploded, and the same can be said on an annual basis. Like I said, this is a fast growing company that is becoming more profitable. And so you might say, okay, then this is purely because the market is expecting interest rates to stay high. This is because the market is expecting less rate cuts than before, meaning before I think the overall market was expecting 6 rate cuts. Now they're probably expecting around 4 or so. And so despite the great performance by SoFi, the continued execution, the triple beat again and again, despite all of that, the market thinks, okay, this company does not deserve to go higher because of those risks. Well, we only have to go back to the latest earnings call to get an even better picture. Because if we look at their own guidance, so they're taking a conservative and pragmatic approach towards their lending segment revenue, expecting to largely maintain it given our concerns about the 2024 macro environment as it relates to uncertainty on rates, the economy, and industry liquidity. Therefore, we will manage the lending segment revenue to be 92 to 95% of 2023 lending revenue. This very conservative view of lending reflects our choice to limit lending growth below both the much higher level of demand we have had and expect to continue to see in 2024 and the capacity that we have. Even with our conservative view of the lending business, we expect 50% growth in revenue of tech platform and financial services combined, and to add at least 2.3 million new members in 2024, which represents 30% growth. Again, reiterating here in the same earnings call just a couple of paragraphs later. For 2024, even with our conservative view of the lending business at 92 to 95% of 2023 revenue, we expect 50% growth in revenue of tech platform and financial services, and to add at least 2.3 million new members, which represent 30% year-over-year growth. We anticipate adjusted EBITDA margin of approximately 20% in the first quarter, ramping to our long-term target margin of 30% by year end, which equates to a range of 2024 EBITDA of $580 to $590 million. So as you can see, guidance for 2024, just like guidance for 2023, by the way, is very conservative. This allows them to beat their own guidance, but this also allows them to have some margin of safety in case things don't go the right way, especially right now with regards to rate hikes. No rate hikes, interest rates stay higher for longer, delinquency rates, etc., etc. They are putting the bar, I won't say extremely low, but lower than expected, giving them the opportunity to beat or adjust throughout the year. There is more. So an analyst here asked, you guys are taking a fairly conservative look at the economy. I think that's dictating or guiding kind of how you want to balance the growth between the lending segment and the non-lending segments this year. And I'm just wondering, if things kind of pan out a little better than expected, would that change the trajectory? And then how do you think about kind of lending segment versus non-lending segment as we get into next year? To which Anthony Noto here answers, I think if the economic backdrop is vastly different, it will change the trajectory both up and down. I would think about that both ways, could be worse, could be better. As I think about the different businesses, some things that could give us a tailwind if we do see rates decline. Our home loan business really would benefit from refinancing in the mortgage business and would benefit from greater purchases. Right now, rates are quite high and it stifled the growth in that market, but that would be a benefit. The second product I'm not going to touch that much on is, of course, the SoFi Invest, SoFi Money, better rates, stuff like that. But then this is the most important part here. I would say if the rate cuts are in fact 6 times instead of what we're forecasting at 4, I do worry about the economy. I don't see a world in which we have 6 rate cuts and we have a strong economic backdrop. The market quickly switched from in late October, going from higher for longer to 6 rate cuts in a matter of 90 days. That tells you how bifurcated the market is and how concerning things can switch so quickly. So we want to be conservative in our outlook as it relates to risk. We have the benefit of being able to be conservative in our outlook because of what we've done in growing the financial services segment and the technology platform segment. And now that the financial services segment is profitable, on a contribution profit basis, we can grow even faster and it doesn't drive our losses up. Same thing with the tech platform. We invested meaningfully over the last 3 years. We are now in margin expansion mode and revenue acceleration mode. So having all 3 businesses is a direct result of our broad-based strategy of giving customers what they need to get their money right, but also results in more durable and diverse revenue streams. Now, in a situation where the economy is weaker than expected, losses will go up, meaning all the bank data is very telling in charge of rates and delinquencies, as well as reserves for losses that indicate that normalization is happening across the spectrum, and we want to be prudent to make sure we factor that into our risk profile. What does that tell you? It tells you, or at least it tells me, that management knows exactly what it's doing. It's prepared for when the market will go up, and it's also prepared and manages the risk if the market will go down. Maybe in the short term, the stock market doesn't like this, but for me as a long-term investor, I see this as an opportunity, and I see, again, the track record of this management throughout the pandemic, before and after, has been close to flawless. So I'm sitting on my hands right now. There was also some other news that came out with regards to Aaron Webster. He will join PayPal's team as Executive Vice President, Chief Enterprise Service Officer to lead global financial crimes and fraud prevention. You might remember that name because he used to work for SoFi. And by the way, back in February here, SoFi hired a new Chief Risk Officer, which meant that the former CRO, Aaron Webster, will remain in the company but in a new role. You also remember that name because that's one of the names that have sold quite a lot of shares late last year. And so right now, if you look at the graph here, the stock is where we've been before back in October and November. We found some sort of support here at around $7. That doesn't mean that we never went underneath it. We did go underneath it, but we didn't stay under $7 for so long back then. Of course, before early January, stuff like that, we did go all the way back to $5. But like I said, right now, the company is much stronger and in a much better position. So there you have it. That's all I have to explain right now with regards to SoFi. If you're a long-term investor, you shouldn't panic. If you're a trader, you should love these types of moves because I do think that SoFi is a trader's dream. We go up, we go down, we go up, we go down. You could make a lot of money. If you're a short seller, enjoy the short-term gains, but be prepared for long-term pain. That's about it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.